This split-screen visualization shows the exponential upward trajectory of AI capability benchmarks on the left, contrasting with two slumping macroeconomic indicators on the right, the U.S. labor share and M2 monetary velocity. M2 monetary velocity is a metric that tracks how frequently a single dollar circulates through the economy to purchase newly produced goods and services. Prominent technologists point to the left side of the chart to promise the largest productivity gains since electrification. Standard macroeconomic models assume that massive leaps in corporate output will naturally translate into broad economic health. A close reading of the data suggests these specific productivity gains are signaling extreme, imminent structural fragility in the global economy. While a typical bubble burst stems from an investment's failure to deliver returns, this scenario stems from the productivity boom itself. The immediate risk is a distribution and contract mismatch, a failure mode that can occur regardless of whether humans maintain control over the technology. Our financial institutions, from mortgage underwriting to tax codes, are anchored to the assumption that human cognitive labor is scarce and stably compensated. As AI relaxes this scarcity, those institutional anchors become sources of systemic fragility. Rapid AI adoption is shifting the risk from a supply-side failure to a catastrophic demand-side macro-financial crisis. At the microeconomic level, replacing human contractors with autonomous AI agents yields immediate, measurable return on investment. Firms achieve these savings because it is entirely rational for their individual profit margins. Duolingo recently provided empirical proof of this trade-off. Their executive leadership openly acknowledged that small hits on content quality were an acceptable price to pay to move quickly. They phased out human contractors for work neural networks could handle. This substitution is expanding into the corporate hierarchy. IBM and LTI-Mindtree are currently deploying agents that triage HR tickets and schedule resources, proving that middle management administrative chores are now technically automatable. This multi-node flowchart maps the aggregate demand externality. A single firm optimizes its costs by displacing labor, but fails to internalize the effect that collective labor displacement has on the total economy. Step 1. Displaced white-collar workers immediately reduce their household consumption. Step 2. This reduction in aggregate spending creates revenue margin pressure on the remaining firms in the market. Step 3. To survive the margin squeeze, those firms accelerate their own AI adoption to lower operating costs, completing the loop of the displacement spiral. Historically, task reinstatement counteracts this loop. Task reinstatement is the process where technology creates new, labor-absorbing tasks that require human judgment or oversight. Crisis occurs when the economy enters the explosive regime. This is the mathematical threshold where AI capability growth outpaces the speed of institutional job creation. If capability growth remains sufficiently rapid, while institutional adaptation remains slow, the model predicts a sustained contraction in the labor share of income. This contraction generates ghost GDP. Ghost GDP is the widening gap between measured real output and consumption-weighted income. This line chart maps the divergence post-2020, where aggregate output continues to climb, but the personal income that actually funds consumer spending fails to keep pace. This divergence is governed by the marginal propensity to consume, or MPC. MPC is a metric that tracks the percentage of an additional dollar of income that a household or entity spends on consumption rather than saving. This diagram shows a transaction pipeline. On the labor side, workers have a high MPC. They spend roughly 85 cents of every dollar earned, driving a deep, interconnected chain of further economic transactions. On the capital side, corporate reserves and equity owners spend only about 15 cents per dollar. The transaction chain halts almost immediately. This asymmetry alters the quantity theory of money, expressed as MV equals PY. M is the money supply, V is velocity, P is the price level, and Y is real output. As AI routes more total output through the capital pipeline, monetary velocity, the speed at which money changes hands, declines. AI-driven price deflation might raise real incomes for some households, but it provides no relief for fixed nominal debt service obligations, like mortgage payments. Standard demand-side indicators like GDP growth will remain misleadingly positive as the consumption-relevant economy contracts. The contraction hits intermediation businesses first. These are sectors that extract profit margins by reducing information friction, such as search or comparison costs for their clients. AI agents can perform these search and comparison tasks autonomously, reducing information friction to near zero. Without friction to justify premium pricing, intermediary margins converge toward the infrastructure floor of raw logistics costs. This data table highlights the sectors with maximum exposure. Seat-based SaaS, or software as a service, and management consulting currently derive 60 to 80% of their margins from information friction. The white-collar workforce absorbed in these sectors sits primarily in the top income quintiles. This targets the consumption concentration amplifier. This stacked bar chart breaks down U.S. consumption. The top 20% of earners drive approximately 59% of total aggregate demand. A concentrated 10% income shock to this top cohort generates a 5 to 6.5% drop in total U.S. consumption. Because high-income earners are the primary consumers and the most AI exposed, the macro-financial transmission is disproportionate. This concentrated demand shock travels to the end of the economic transmission chain, global credit markets. The stakes involve the $13 trillion U.S. residential mortgage market and the leveraged $2.5 trillion private credit market. These valuations are underwritten entirely on the assumption of white-collar income stability. This bell curve maps default probability based on a borrower's debt service coverage ratio, or DSCR. DSCR is a metric that compares a borrower's income against their debt service obligations. A healthy prime borrower carries a baseline 2% annual default risk. A permanent 20% income reduction from AI displacement fundamentally alters that risk profile. As their income drops, the borrower slides into the fat tail of the curve. Their default probability spikes from 2% to 18%. This is the convexity problem. Successive income losses compound default risks non-linearly. Prime mortgages and private credit portfolios will begin to exhibit the systemic fragility historically reserved for subprime assets. This credit shock stems from the structural evaporation of the white-collar income that underwrote these high-quality loans. The depth of an AI-driven macro-financial crisis is a policy variable, determined by how quickly economic institutions adapt to the loss of labor scarcity. Standard central bank monetary policy, specifically interest rate cuts, is structurally inadequate for this displacement. Making borrowing cheaper does not replace permanently displaced labor income or accelerate the creation of new tasks. This line graph simulates the policy response function. Averting a crisis relies on the speed and magnitude of fiscal transfers to move AI productivity gains back to household income. Implementation lags determine the outcome. The longer governments take to execute fiscal restructuring, the deeper the structural damage becomes. To accurately track this transition, abandon raw GDP as a health metric. Ghost GDP makes output a misleading indicator of household economic health. This analytical dashboard tracks the true early warning indicators. Watch for SaaS net revenue retention dropping below 110%, wage compression in AI-exposed roles, and rising prime mortgage delinquencies in technology hubs. Localized housing corrections in high-tech metros will be the first physical manifestation of the convexity curve breaking. Unless economic institutions are re-anchored to account for abundant intelligence, the flattening of the corporate hierarchy will likely flatten the aggregate economy.